The year is underway, and this is our first look at how 2026 started. After a period of uncertainty, the US economy is showing signs of stabilization. But the picture remains mixed. Inflation pressures are still present, global risks continue to matter, and policy decisions remain an important factor. Today, we're breaking down what happened in the first quarter and what it might mean for the months ahead. Let's start with the big picture. The latest data shows the economy moving forward, but only modestly. GDP growth for the end of 2025 was revised down to 0.5%, reflecting slower pace. Consumer spending and private investment held up, while government spending and exports weakened. After the volatility seen last year, the economy appears to be stabilizing, but not accelerating. Now to the labor market. At first glance, things look steady. Unemployment held around 4.3%, with little overall change. But underneath, the monthly data was uneven. Job gains in January were followed by a decline in February, and then a rebound in March. Healthcare, construction, transportation, and warehousing added jobs, while federal employment continued to decline. So while the labor market remains resilient, the pace has been inconsistent. Inflation is where pressure is building again. In March, consumer prices rose 0.9%, bringing annual inflation to 3.3%. A key driver was energy, with prices affected by geopolitical tensions in the Middle East. At the same time, core inflation, excluding food and energy, remained around 2.6%. So while underlying inflation has not surged, headline prices are still being pushed higher by external factors. That brings us to the Fed. After multiple rate cuts last year, the Federal Reserve is holding steady. The federal funds rate remains at 3.75% as officials take a wait-and-see approach. Their message is clear: the economy is stable, but uncertainty remains high. Future decisions will depend on incoming data, especially inflation and employment. Now let's talk housing. Here, the shift is already visible. Mortgage rates edged up from 6.34% to 6.43%. Mortgage applications also declined, with both purchase and refinance activity slowing. At the same time, home prices are still rising, and the house price index is up 1.6% year over year. The market is not reversing, but it is cooling. So what's next? The second quarter may bring some turbulence. Global developments, policy shifts, and inflation risk are still in play. But the baseline case remains a relatively stable economy with continued monetary easing over time. If that holds, it could support both the broader market and housing activity in the months ahead. One thing is clear: 2026 is not opening with strong economic pull in either direction, but with balance. Subscribe to AD Mortgage to stay informed and better navigate the market ahead.